Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
We are diving straight in because the volatility around Netflix right now at the start of 2026 is just unprecedented. The deal to buy the core Warner Bros. Discovery assets, we're talking an $82.7 billion enterprise value, has completely split the market. This is a true battleground stock. It's been hammered, and right now it's trading hands in this really tight high volume range, somewhere between $89 and $91. And that's after the 10-for-1 split they did back in November.
And that price action is all about fear. It's not just, simple uncertainty. If you actually look at the data, it tells a story of big institutional money actively positioning against this deal. We saw a huge signal on January 2nd. The FINRA short volume ratio spiked to 32.21. Now, to put that in context for everyone listening, that means nearly a third of all shares traded that day were short sales. This isn't just retail investors getting nervous. This is an aggressive bet from the big players that there's a serious downside here, or, at the very least, that the stock is going nowhere for a long time.
The numbers absolutely confirm the intensity. And that brings us right to our central question for today, which, it might be the defining question for the entire media sector for the next decade. Does this massive pivot, the biggest integration in entertainment history, does it secure Netflix's future as this unassailable global media giant? Or, on the other hand, does the crushing weight of the debt, the complexity, the dilution, does it subject the company to, frankly, an existential risk? I'm firmly in the camp that this is a necessary, even brilliant masterstroke for the long term.
It's a very appealing story, that idea of inevitable dominance, but I can't get past the financial reality of it. The ambition is there, I'll give you that, but the immediate financial and operational risks are so massive, they completely change what this stock is. And for me, they make the equity highly unattractive for the foreseeable future.
Well, look, the bullish case for me is built on three main pillars: the content moat, their operational superiority, and just proven management. First, the WBD deal is a decisive move because it secures an intellectual property moat that they just couldn't build organically. Not indefinitely, anyway. You can't just wish the next Harry Potter or Game of Thrones into existence. This deal gives them ownership of those Tier 1 generational franchises that are absolutely essential to reduce churn. Second, this whole move is backed up by real operational strength. Netflix still has the lowest churn in the industry, and critically, it boasts a 30% operating margin. That absolutely dwarfs a company like Disney, which is struggling to stay in the 10 to 12% range. That margin is the engine that's funding this whole $82 billion bet. And finally, you have to look at the management. Ted Sarandos has perfected this eventizing of streaming. Just look at the Christmas NFL doubleheader, 27.5 million viewers. It was a massive success. And next to him, you've got Greg Peters, who is just elite at technical monetization. The ad-supported tier already has an incredible 190 million monthly active users. This deal makes them the one single fortified media utility.
Okay, I hear you on the operational metrics. They are strong, and the core Netflix machine is efficient. I won't argue that. But we have to address the reality of the capital structure here, because it fundamentally shifts this investment from a high-growth tech stock into a highly levered media conglomerate. The number one risk is the radical change to the balance sheet. That $59 billion bridge loan. We can't just ignore that we're in a high interest rate environment. The risk-free rate's around 4.19%. Servicing a debt load of that size is going to consume billions in free cash flow every single year, cash that used to be for making new shows or buying back stock or other small acquisitions. This debt is a gravitational anchor on innovation. Then you've got the dilution, which is just as bad. They have to issue hundreds of millions of new shares to pay for part of this.
It's a very real ceiling on the stock price, and it immediately hits their short-term earnings per share. And on top of all that, the market is punishing them because they're overpaying for declining assets, specifically WBD's linear TV business. That legacy rot is exactly why Disney trades at a much lower PE multiple, around 16.7, and it's why Netflix's multiple is already compressing. And that's before you even get to the regulatory mess, the FTC, the DOJ, the EU, which is just going to create this inevitable overhang that keeps the stock as dead money for, 12 to 18 months at least.
That is a powerful summary of the debt risk, I'll grant you. But let's circle back to the market action itself, to that huge short interest. I think people are fundamentally misinterpreting why it's there. If sophisticated investors really thought this deal was going to kill the core business, they'd be shorting because they see a structural failure.
And I think they are. That 15.1% rise in short interest since the last report, that signals a real fundamental bearish belief. It validates what some are calling the leverage trap thesis. The argument is that sophisticated funds are shorting the stock as a proxy for the increased credit risk. They're not betting that people are going to stop watching Stranger Things. They are betting that the cost of servicing $59 billion in debt will eat up so much capital that the value of the equity just erodes, no matter how good the IP is. It's a bet on the cost of capital being more powerful than the value of content.
See, I understand the leverage trap idea, but I think the real driver here is something much more systematic and less fundamentally bearish. It's merger arbitrage. We have to be clear about this because it's a cash and stock deal. Arbitrage funds have to buy WBD shares and at the same time short Netflix shares to hedge out the market risk until the deal closes. And that's not expected until Q3 of 2026. This isn't a vote of no confidence in the Netflix model. It's a required financial mechanic to lock in the price spread.
But arbitrage would only explain some of the volume. If it was the only driver, that spread would be a lot narrower than it is right now. The size of the spread suggests the market has real concerns about regulatory approval or, more likely, a failure to integrate. If the market truly believed those $140 price targets, the ARBs would be overwhelmed by fundamental buyers. We are not seeing that.
The liquidity metrics actually back up my point, though. The days to cover is incredibly low, just 1.1 days. That's a direct result of all the new liquidity from the stock split. And it tells you that this volume is transient and highly structured. The shorts can get out easily. If this were a widespread belief that Netflix was collapsing, we'd see that days to cover number stretch way out because it would be hard to find shares to buy back. This is just finance pros locking in a spread, not widespread panic.
That's a fair technical point, but even if the short interest is just a hedge, that doesn't solve what I think is the biggest hurdle they face: the integration. Arbitrageurs will go away eventually, the culture clash is permanent, and that's where the real risk of value destruction is.
That is an interesting point. And you're right, it's probably the biggest hurdle. But I would argue that the integration fear is precisely why their dual CEO model is so critical right now. The combination of Sarandos's content vision and Peters' operational ruthlessness. That's the counter-argument. Greg Peters, who I kind of think of as the technocratic monetizer, he's the key here. He has this flawless reputation for technical scalability and efficiency. He pulled off the password-sharing crackdown with almost no subscriber loss, and he rolled out the ad tier at lightning speed. His track record says he can streamline WBD's bloated, old-school operations. This isn't about merging cultures. It's about Netflix imposing its superior, data-driven tech stack onto the assets they bought. They're buying the IP and applying the Netflix operating manual to it. I'm just not convinced.
Because you are betting against decades of corporate history. I mean, we've seen this disaster movie before. AOL Time Warner, AT&T Time Warner. The sheer complexity of trying to merge Netflix's decentralized, move-fast Silicon Valley culture with WBD's very relationship-driven, hierarchical Hollywood model, it creates this organizational fault line. You're mixing digital natives with broadcast fossils. This integration nightmare could cause a catastrophic talent drain. The top showrunners, the creative execs that they are paying $82 billion for, they might just walk rather than have Netflix's efficiency models forced on their creative process.
But if Peters can find even a fraction of the cost synergies they've targeted, let's say he cuts $5 billion from WBD's overhead, that massive margin improvement services the debt very quickly. The question isn't whether it's hard, it's whether the operational upside is worth the difficulty. And the IP was a necessity. They had to move.
They had to move because they were losing ground. And that brings us to the valuation problem. You say it was necessary, but that necessity came at a huge cost to their valuation. The data shows Amazon Prime Video has already passed Netflix in U.S. streaming share 22% versus 21%. So Netflix had to buy scale instead of growing it organically. By buying linear assets, TNT, CNN, all of it, Netflix is voluntarily moving from the pure tech growth bucket into the media bucket. And that media bucket has always had a dramatically lower multiple. We're already seeing their PE ratio compress, dropping from the high 30s down toward 28 since the announcement. You just can't keep a high-flying tech multiple when you intentionally inject legacy media rot into your business model. The market is pricing that in.
But I had to defend the premium here. Even at 28 times earnings, Netflix still has a massive premium over Disney's 16.7. And that's precisely because of its foundational 30% operating margin and its efficient asset-light core streaming business. I think the market is over-discounting the strategic value right now. Yes, the cost is high, but the alternative was content stagnation and a slow bleed of their best subscribers. You have to factor in the strategic need. The WBD assets, especially the HBO library, are key to lowering churn among the high ARPU subscribers, the ones who pay more and leave less. This was a self-preservation move in a winner-take-all market. To win globally, they needed an inventory nobody else could touch. That's what they paid for.
But the market is focused on the leverage. It's hard to look away from the fact that the combined company's cash flow is going to be allocated to servicing debt in a way that looks terrifyingly similar to an old media company. This isn't a small loan. This is a change in the corporate DNA. And that leverage exposure is why you're hearing so much chatter about the deal potentially being blocked by regulators.
Ah, yes, the contrarian win-win narrative, which I have to say is a fascinating look at the current sentiment. The argument is pretty simple. If the deal gets blocked, the stock might actually rally a lot. It avoids the $59 billion in debt, it avoids the dilution, and it avoids the integration nightmare. What that tells you is that a huge chunk of the current bearishness keeping the stock around $90 is tied directly to the execution risk of the merger itself, not a loss of faith in the core Netflix model. Take that risk away and the stock could fly.
It just shows you how perfectly fractured the sentiment is. You have retail dip buyers who see anything under $100 as a bargain. They're still stuck in that pre-split growth mindset. Then you have the sophisticated money that's terrified of the leverage trap and this legacy media rot. You've got two completely different investment theses fighting it out, which just confirms that this stock is going to be tethered to merger headlines and arbitrage flows for the entire year.
And that's the critical dynamic for the short term. My position is still that the long-term strategic win of consolidating the world's best IP, it outweighs the cost of the bridge loan and the temporary dilution. This deal, if Peters and Sorrento's can pull off the integration, it guarantees Netflix's status as the one unassailable global content utility.
And I remain deeply skeptical. The execution complexity, the enormous debt, the regulatory limbo, it all creates a risk profile that I think will crush shareholder returns for years. The real fate of this company now hinges entirely on whether Greg Peters can navigate the most complex corporate integration in entertainment history without breaking the foundational Netflix algorithm, that data-driven, hyper-efficient machine that made them a giant in the first place. This is less a debate about streaming anymore and more a sophisticated bet on CEO execution under extreme duress. We're watching a high-stakes corporate tightrope walk.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.